Okie dokie. Okie dokie, everyone. Can I start off by saying either a very good morning, or a very good evening, or even a very good night, depending on where you are around the world. Thank you for joining me tonight. My name is James Alexander, and I'm hosting tonight's webinar for Banc. So thank you very much for coming along and joining me. Now, tonight's webinar is part of a series I've written called Discover Trading. And tonight's episode is called Discover Support and Resistance. Written, of course, by yours truly, by myself. And like I say, my name is James Alexander. I'm the market analyst here at Banc. Now, let me give you a brief introduction on myself. Hello, Richard. A brief introduction on who I am. Like I said, my name is James Alexander. I'm the market analyst here at Banc. I have over 20 years experience in the financial service industry. I actually started out as a mortgage broker at a ripe old age of 18 years. I'm now 40, and despite the way I look, I am not 50, I am indeed 40. So I started off in the financial service industry, specializing in mortgages, commercial mortgages, before moving into alternative investments, and then entering online trading and CFD trading and option trading around about 12 to 13 years ago. I've actually traded myself through the Dubai's Gold and Commodity Exchange, and I've run or managed several floors around the world, including the Philippines. Okay. I then went into portfolio management and looking after VIPs. Can you hear me, Richard? Can everybody else hear me okay? Can everyone else hear me okay? Give me a thumbs up, anyone? Okay. Right, if I move a bit closer, Richard, hopefully that's a bit better. Because, okay. Anyway, I moved into portfolio management before obviously becoming an educator. Okay, thank you, Lincoln here. Okay. Before becoming an educator. Now, I'm also a published writer, and I've been published in several leading industry publications, including the Financial Times Advisor and Market Watch, The Street, FX Traders Magazine, City AM newspaper, you name it. Mainly a lot of opinion pieces on how I see the market, how I see sort of like base rate decisions, things like that, and maybe some chat on commodities. So I often write a lot of articles and often get published, about what I think and what I potentially see. I'm an avid market commentator, and one thing people will say about me is I'm extremely passionate about the markets. I get very excited, and I enjoy talking about them because they can be extremely exciting. And some people say maybe I like the sound of my own voice. I'm just passionate. As well as that, because I'm passionate, and I do actually go around and do a lot of public speeches in industry events. I've spoken in Dubai lots of times, the UK, obviously, as you can tell, I'm a Brit, Singapore, etc. Now, one thing I will say about myself, okay, and I've got a fair many years under my belt of experience in this industry, okay? And what I will do is I will show you my experiences and my knowledge, my mistakes, as well as my successes, as long with my passion. So that's what I will say about myself. But what I will say, and this is what makes me different from a lot of educators out there, is I do not once ever call myself an expert. The reason why I say that is because I personally believe no one is an expert in this marketplace. Okay, so really what I do with these webinars and these educational events is I share with you this information, this knowledge, with the idea that you can take it on board, learn it for yourself, and hopefully find your own path. So that's what I will say about me. Now, tonight's agenda, like I say, this one's called Discover Support and Resistance. So obviously, starting off, of course, we'll talk about what actually is support and resistance. Then we'll have a little discussion on pivot points, what pivot points are, and how you can personally calculate them. We then go into obviously talking about using technical indicators to find these potential support and resistance. And then we'll go and discuss a few methods that some traders do to use support and resistance in their trading. Then, of course, we'll discuss the other educational events coming up in October, and end as usual, my usual question and answer session. So what I will say, if anybody has any questions related to the webinar, please hold back until the very end, and you will be given a chance to ask me anything. And like I say, if I have the answer, well, know the answer, I certainly will share it with you. So here's the question. Here's the thing. This is what it's all about. What is support and resistance? Now, support is a level where an asset could fall to and the market starts to buy in again, i.e. acts like a trampoline. So you have an asset falling, hits a particular level, and then the market starts to buying in, pushing it back up again. So like a trampoline. Resistance is the opposite. Resistance is a level where an asset could rise to and the market will suddenly start to sell off again. Okay? A pivot can also be a resistance and support, but we'll talk about that as well. So it goes up to a certain level and the market starts to sell off again. So yes, a bit like a ceiling. So an asset rises, hits this level, starts to sell off, and then starts to collapse. Now, traders try and study support and resistance, or try and identify where the support and resistance levels are, to engage potential entry levels and exit levels, but also at the same time to sort of maybe decide where to put their stop loss or take profits levels. So this is why people look for the support and resistance. Now, as you can see, is my very crude drawing here. Obviously, you can see it bounce like that. Now, at times, and there's a few examples we'll go through, at times when either a support or resistance is indeed broken, what they then tend to do, and this is one good way of finding out if indeed it is broken, okay, is it changes its roles, i.e. the support then becomes the resistance and the resistance becomes a support. And it's a good way to sort of try, when you identify this, and identify if indeed that level is broken for that time being. Now, pivot points, okay, is one method you could try and use to calculate. So it's trading above the pivot point is potentially bullish. Or if the asset is trading below the pivot point, then it's potentially bearish. So this is, what they try and look for, is the pivot point, is the calculation. And there's many ways of doing it, but this is quite a simple way of calculating pivot points. Because at the same time, with that theory, if it's above, it's potentially bullish, below it, potentially bearish. You can also use it to calculate, like I say, where the potential resistance and support is. And it's very simple, okay? Very, very simple. You simply take the highest price of that asset during a period of time. You take the lowest price of that asset during that period of time, and you take the closing price of that selected asset at that period of time. Obviously, with a 24-hour market, many people try and take the closing price, the high and the low of the session before. Now, here's the calculation again. So to calculate the pivot point, which is the average, okay? You take the high of that asset for that session or for that time period, you plus the low of that asset during that period of time, and you plus the close of that asset during that period of time. And then what you do is you divide it by 3, and hey presto, it gives you the pivot point. Now, to use the pivot point to work out or calculate the support, you get that pivot point, you times it by 2 and minus the high from that period of time, it gives you the support. To get the resistance, you get the pivot point again, times it by 2 and then minus the low, and that potentially gives you the resistance. So in this example, this is something I did with the euro a little while back. On the euro session, we had the high of 1.1533, the low of 1.1411, the close at 1.1438. We added those three numbers together, divided by 3, and it gave us the pivot point of 1.1460. Sorry, Richard. Other people can hear, my friend. What device are you using? What device are you using? Is it a mobile or a tablet? Everybody else can hear me okay, though, yes? Because I know Lynn says she can. I had a Pedro said he can hear me all right. Okay. Let me send you a private message, my friend. Give me 2 seconds, Richard. 2 seconds. 1 second, Richard. I'm experiencing technical difficulties. Give me a second. Right, that's why I'm trying to help Richard out. Let me carry on. So yeah, so add those three numbers gave me the pivot of 1.1460. For me to work out the resistance, oh, you can hear me now. Oh, excellent, brilliant, excellent. To work out the resistance, we take the pivot point, 1.1460, times it by 2, minus the low, gave us the resistance of 1.1509. And for the support, the pivot point, again, 1.1460 times 2, take away the high of 1.1533, gave us the potential support of 1.1387. So those are the areas of interest if we would decide to calculate pivot points and use them to try and identify potential support, resistance, and if indeed that asset is bullish or potentially bearish. Now, the other very popular way many traders use to try and find or establish where the support and resistance is using obviously technical indicators. Now, there's several technical indicators you can use, okay, to try and identify the support and resistance. I'm going to give you 3 examples of some you can use. One which is extremely popular, and the one I like to look at and use, are channel lines. Okay, now channel lines, basically you drew it with a naked eye. As you can see, I've done it here. This is the euro-dollar pair on a daily chart. Okay, I've identified the line of where the asset rose to before the market sold off, and I identified a level where the asset, or the euro-dollar in this case, fell to, and the market started to buy in again. Okay, and as we can identify, these channel lines are acting indeed as a support and resistance, because as it touched that level there, give me a little pen here, laser pen, here we go, touched it out, the market started to buy in, and then when it touched the resistance around this stage, the market started to sell off. Then again, as it hit the bottom channel line, the market started to buy in again, buying in again. Didn't quite hit the resistance this time though, but it came close to it before the market started to sell off again. Here, it broke it. Okay, it broke it. Because like I say, not every level or line survives or stays the same forever, or else otherwise, of course, this market would be easy. However, though it temporarily broke down below it, it didn't actually really break that level. And how do we know that? Because, as I remember what I said, support comes the resistance, and the resistance becomes the support. Not once to the support level, when the market came back, held it. So it didn't become a resistance, it didn't stop its roll, and instead, again, switched back as the market retraced backwards, again, to being a support. And again, the resistance in that channel line. So this is a good method of trying to identify where the potential resistance and the potential support is. Here's another example. This is a dollar yen. Now this is on again, it's a daily chart. Okay, identified obviously where the market started to buy in, so I drew my channel line across, and I identified the levels obviously where the market had sold off from. So let's have a look again. Obviously beforehand, here we go, it's a great example actually. If you look beforehand, this acted as a minor resistance for a while. Market challenged it, eventually broke it, and it then started to act as a support. It acted as resistance initially, but then once it broke it, it did indeed switch its role and become the support again. So obviously then it touched the bottom, hit the bottom line, and the market started to buy in. And obviously there again, we see channeling at the resistance, the market selling off. So this point here, if you look here, it came close, but didn't quite touch it. But just above the support line, the market started to buy in again. So again, those channel lines were quite giving us a good indication of where the potential support and resistance indeed is. Here's another one. This is the British pound US dollar. Okay. Obviously the pound's going through a hell of a time at the moment. So as we can see, it broke down below it at this point, okay, and it acted like a sort of minor resistance. Eventually it broke. Again, it swapped roles, resistance becoming the support, and indeed the market started to buy in around that channel line, showing that that channel line is indeed a support. Again, we saw the high, so there was indeed our resistance level there. We can see it back there, actually. The market actually tried to challenge it and break it there. So yeah, it acted as a resistance, the market selling it off, and indeed there, and indeed, of course, coming to the bottom channel line, acted as support, and the market started to buy in again. Moving averages. Okay, this is another technical indicator that people can use, okay, to try and identify where the potential support and resistance is. And there is something else you can use the moving average for as well. The theory is, with the moving average, okay, is that if the asset is trading above the moving average, okay, then that asset is potentially on an uptrend. If the asset is trading below that moving average, then potentially that asset is in a downtrend. Okay, so again, the moving average is giving us potential heads up or a potential indication of where the market's going. But at the same time, the theory is that it then acts as a support and resistance depending where the asset is. If the asset's above it, of course it acts as a support. If the asset's below it, it acts as a potential resistance. Let's have a look at this example. This is gold. This is on an hourly chart. Okay, so at this point, okay, this point here, obviously underneath the moving average, so it is indeed in a downtrend. Acts as a minor resistance here. Tried to touch it, tried to touch it, tried to touch it, and it held it. Eventually it broke. Like I say, it doesn't always last forever. But then it broke below again, and again acted as a resistance level, holding gold down. So eventually, of course, it broke. Guess what? You know the rule. Resistance becomes the support, support comes the resistance. Here we go, we see it again. It then acted as a support and held gold up, during several hours during that session. Eventually, it then broke below it, and hey presto, again, switched roles, and indeed then acted as a resistance. Here's another example. This is euro against the British pound. Again, above the moving average, indicating a uptrend. And as we can see, indeed, it did act as a support as it was above it. On several occasions, actually kept it, till eventually, like say, it kept holding it up, till eventually, of course, it challenged it, and eventually sort of held it for a little bit longer. Again, it switched roles slightly, but not long enough, broke it until eventually it did indeed break it, and then acted as a resistance. Bollinger Bands. Now, Bollinger Bands, again, is another popular technical indicator. And Bollinger Bands are used for two different things, not just, of course, for identifying potential support and resistance, but also to measure the market volatility. The theory is, if the bands are wide apart, okay, then the market is extremely volatile. If the bands are closer together, then the market is not so volatile. Now, depending on obviously your attitude to risk and your trading style, some traders try and only really use Bollinger Bands when the market is not so volatile, because then they seem to see if they can try and range trade. So when the bands are close together, like here, they're close together like here, like this, you see. So the theory is, when it's close together like that, the top band acts as a resistance, and the bottom band is given as an indication where the potential support is. So let's have a quick look on my example here. As we can see, hit the top band, market started to sell off again. Hit the bottom band, the market started to buy in again. Hit the top band, the market started to sell off again. Hit the bottom band, though it did challenge it, it did eventually start to buy in again. Now, here's the other thing. Okay, the other theory is what some traders do. It's not just the top band, which can act as a potential resistance, or the bottom band, which can act as a potential support. It's the middle band as well, which is often used, which is a moving average. Now, what some traders do, okay, is that when they say they do their trade, they set their take profit or their trailing loss to be, to lock in some potential profit round about the middle band, because they know that sometimes the middle band can indeed act as resistance and as support. As we see here, it hit the bottom band, and the middle band this time acted as a resistance. So obviously, if a trader was doing a trade here, some traders, like I say, would either do a trading stop or set their take profit to lock in profit around this level, just in case it held as resistance and it wasn't the top band, which acted as resistance at that time. And as we can see again here, it hits the bottom band and the market indeed starts to buy up again until, of course, it hits the top band here and the market starts to sell off. Here's another example. And this is a good example, actually, of, like I say, when I say some traders use Bollinger Bands and only trade when the market's not so volatile, opposed to when it is volatile. Because that's the theory goes that when it's less volatile, the bands can indeed act as a support and resistance. And as we can see here, this period here, it wasn't so volatile. And it was a good sort of period of time for maybe doing some range trading, depending on your trading style. However, when something happened, very volatile, as you can see, the bands are wide apart now, saying that that is a volatile moment in the market, not really, giving us a sort of key sort of level of support. So maybe traders who use Bollinger Bands wouldn't jump in at this very moment. They'd probably wait to around when the bands get tighter together like this, and this is when they're a range trade, obviously from the bottom band to the top band to the top band to the bottom band. So that's how some traders use the Bollingers, to try and identify support and resistance, and also to see how volatile the market is. Now, here's some methods. Excuse me, a little drink because my throat's getting dry. Here's some methods of how some traders trade the support and resistance. Okay, some look for the bounce, and the bounce is when you see an asset comes, touches that level, and straight away bounces up. Some traders trade the bounce, jumping in as it bounces off that support or that resistance. They would do it in a certain way. Some traders, again, I'm a big fan of stop losses. I'm a good fan of making sure you plan your trade before you jump in. Some would then probably set their stop loss just below that support to, protect themselves. So that's the bounce. That's some methods of trading. The other way is called the break. Okay, so they wait for a level to be broken. And then what they do, they see the asset come through. As soon as it breaks that support, in their theory, in their opinion, they then jump in, again, setting a stop loss quite tight above it in case they're wrong. That is like the aggressive approach. Those who are very risk appetite, very confident and aggressive moves into the market. There's the other type who trade the break, but they trade it a little bit more cautiously. And this is sort of the sort of theory I like a little bit more as well, to be fair, because I do believe in, obviously, the first rule of thumb when you're trading is to protect your trading account, okay? Protect your trading account. So what they do with the break is the cautious approach. They see the asset break through that level, but they don't jump in. What they do instead is they wait. They wait for it to come back up and test it and to see if indeed that level has changed its roles. So an example of this, okay, this is a support level. So some traders would wait to see if indeed it is broken and it's indeed swapped its role and become resistance. And that's when they would enter, setting their stop loss just above it. So that's the cautious approach, an approach which, I quite like personally. Up and coming educational events for October. On the 4th of October, again, the next episode is called Discover the Biggest Market in the World. Now that is for pure beginners. Okay, this is for those who've never really traded or don't know anything about Forex. I will be covering the basics, like what is a pip, what is leverage, what is a currency pair, what is a jargon. Because actually, to be fair, it's not just for beginners, it's people who maybe have been trading, because I think a lot of people don't really pay attention to the basics or to identify what Forex actually is. They're too busy looking at technical analysis and things like that. But I think that's going to be a good one. So do tune in for that one. That's on the 4th of October. On the 11th of October, I'm doing Discover the Mind Behind the Market. That is going to be for psychology on trading. Okay, on that one, I'm going to discuss, obviously, hope, fear, how to get your right mindset. Okay, because I'm a big fan of that, because I think one of the success routes of being a good trader is controlling your emotions. Okay, so I'll be talking about that. That's on the 11th. 18th, I'll be talking about trends, uptrends, downtrends, and I'll be talking about ranges. So we're talking about ranging market and different trading techniques for that. Then on the 25th of October, I'll be doing a webinar on Elliott waves, the Elliott wave theory, and we'll be looking at stocks with that as well as currencies. So that's a very brief introduction to support and resistance. I now leave it up to you fine people. Has anybody have any questions for me on what I've spoken about today? Anybody like to ask me anything? Any questions at all? Please, you can ask me anything. If I know the answer, I of course will tell you. Okay, did everybody find it at least interesting or useful? Did everybody enjoy it? Or is everybody sick of my voice now? You sick of me already? No? Okay, here's another question then. Yes. Oh, is that yes, you're sick of my voice, or yes, you found it useful, Sasha? Pedro, yes. Oh, good. I hope that's for yes, you found it useful and interesting. Good. I have another question then. I'll ask you fine people. Oh, very good. Oh, thank you, Pedro. I'm glad you enjoyed it. Thank you. I have a question for you fine people. Now, obviously, I do these webinars and I put this education material together, and I will be doing a lot more educational stuff and market stuff. What is Fenerbahce? Oh, your Fenerbahce retracement, Richard. That is a theory, okay, retracement, where if you see an asset on an uptrend or a downtrend, okay, is you basically use the indicator to get to the top where the decline started, say the assets on the downtrend, the top, the high level, and you point it to the bottom level. It then gives you several numbers and points, 50 and 61. And the theory is that if something's on a downtrend, or on this case, a downtrend, if the asset comes up to the 50 or the 60 level, 63 level, the market will start to sell off. Okay, and it acts as a potential indicator for you to buy in or sell in, depending on if the asset's on an uptrend or a downtrend. So that's what Fenerbahce retracement is. It's an interesting indicator. I tried to be absolutely fair with you. I tried to look for an example, because when I do the charts, when I do the examples, I do it on the day of the webinar, so it's live, so you can practically see. You know, it's very interesting to see on the actual day. I don't take charts from months ago. I do it on the day, and I did look to try and do one on Fenerbahce retracement. I find an example today, but there wasn't a real clear one which really showed me that only S&P 500 was a good potential one. But I will do if you like, I will do a case study and a webinar just on Fenerbahce retracement if that is something you're interested in. So yes, Richard, I will do one just on that. Lynn, very interesting. We'll start to apply the formulas. Brilliant. Try looking at the channel lines as well. I'm a big fan of channel lines. I love channel lines. Try using those because I think they're really, really good. So obviously, okay, I'm going to do a Fenerbahce webinar for Richard. Is there any other type of topic or subject you'd like me to cover in the future, people? Anything else you'd like me to do? No, my pleasure, Richard. And one other thing, Richard, as well. If you had a problem hearing earlier on, don't forget, every single webinar is recorded. So in a little while, when I finished, the recording will be made, so you can go back to the link and you can actually watch the recording of it. Watch the recording of it. So if there's anything you've missed, you can hear it all over again. And to be fair, you can watch it as many times as you like, as long as you don't get sick of me. And thank you very much. That's a really lovely compliment, Richard. Thank you very much. I appreciate that greatly. Thank you, my friend. It's very kind of you to say. So obviously, I'll do a Fenerbahce retracement for Richard. Is there any other equity management? You wouldn't need to do a case study on equity management. Yeah, we could do. It's a great lesson. Thank you, Richard. I'm glad you enjoyed it. I could look at doing something similar, linked with obviously online trading to equity management. I do believe in diversification of portfolios. I don't think you should put all your eggs in one basket. I do believe that you should diversify your portfolio. Big fan of hedging as well. So perhaps what we could do, if this is something you're interested in, Lynn, we'll go down the route of doing a webinar in the future, which we're taking a little bit of equity management and obviously, excuse me, risk management, but maybe we'll also maybe discuss and look at some hedging techniques as well, which could obviously help you. So yeah, okay, I'll take that on board and I'll look at that. Very much so. Great lesson. Thank you, Richard. Again, you've been really kind, my friend. Thank you. I'm really, I'm pleased because it gets quite lonely. I'm here talking on my own, and it's nice to hear that at least somebody's getting something out of it and, you know, hearing. No, perfect. No, I like the idea, you know, because our interest in head, yeah, because I like the idea of equity management and risk management being put together and building a portfolio, and I do believe in that. So I think that's something we will look at. And yes, definitely, if Richard, you're interested in hedging, definitely we'll do something on that as well. Combine it with Lynn's suggestion, and then, you know, that will be interesting. Perhaps I'll try and get that organized for the first week in November and get that done. I might even add it to maybe one of the other webinars we have this month. Is there any other questions at all? Anything else you'd like to know, or anything you'd like to ask me, or any other topics in the future you'd like me to do? Okay, if there's no other questions or no other topics or anything else, I'm interested in understanding why the market responds as it does and creates these support resistance levels. Is it partly psychology? Actually, Elizabeth, I think part of it is psychology, because do you know why I think the support resistance works? Is because everybody's looking at them. Everybody's looking at them. You know, because don't forget, when you're working out that, is based on past data. So if everybody is identified as support, then everybody's going to be looking to buy in at that level, which can push the market up. And is everybody looking at the same or similar resistance? Okay, that's where the market realizes they're going to sell from. So I do think, and like I say, some of it obviously is calculations, but I do believe it is in a lot to do with psychology, because let's face it, what really moves the prices is the buyers and sellers. You know, it's the buyers which are moving the market up, and it's the sellers which is pushing the market down. Those are the people who are the most important thing. So if they're both looking at the right same levels and buying in there, or selling at the certain levels and all selling in there, this is why I think, you know, it's the attitude of the buyers and sellers which drives it. So yeah, I do believe it is partly to do with psychology. Good question though, Elizabeth. Thank you. Very good question. Very good question indeed. Thank you. In fact, all the questions have been great, actually, guys. It's been really, really excellent. If there's nothing else anybody else like to ask me or talk about a topic, I'm going to say basically good night, but special shout out to Richard, Lynn, Pedro, Ayub, Lynn again, and Elizabeth, for all your great questions and all your interaction. I love it when people interact, because like you say, you can get quite lonely. I'm talking on my own. So it's nice to hear from you. Okay, so brilliant. So special shout out Richard, Elizabeth, Lynn, Pedro, Ayub, and obviously I said Robert there as well. Thank you so much. Special shout out to you. For everybody else, can I wish you a fantastic, fantastic day? Okay, hey, excellent. You're welcome, Pedro. I'm glad you enjoyed it. Look forward to the next one too. Can I thank everybody else? Thank you so much for joining me tonight. I hope you enjoyed it. Till next time, can I wish every single one of you either a good morning, a good afternoon, good evening, or even a good night, depending where you are around the world. Till next week, every single one of you, trade safe.